Margin. What is margin? Margin is the good faith deposit that you as a trader puts down as a collateral to place a trade. Now, in essence, it is the minimum amount that you need to place a trade. This is one of the biggest appeals in Forex, which is the ability to trade margin. In simple terms, it gives you the ability to enter into larger positions than your account balance. Now, margin trading account displays the following metrics, or should I say measurements of something: balance, used margin, free margin, unrealized profit or loss, or realized profit or loss, equity, and margin level. So for example, as you can see here, like margin on the MetaTrader 4 platform is known as used margin. That's your used margin. Okay, so first one, what is balance or account balance? For you to make money in trading, you need to open a real account with the broker of your choice. Now, once you have a real account with the broker that you choose, you can then deposit money from your bank account straight into your trading account. Keep in mind the amount you deposit in should be the money that you can afford to lose. Now, this deposit is now your account balance. It's the amount of money you can start to trade with. Example, if you deposit $1,000 into your trading account, your new balance is $1,000. If you enter a trade, your balance will not get affected unless the trade is closed. So even if you place a trade and it's in drawdown and it's fluctuating in the minuses, let's say minus $200, it doesn't necessarily mean that now your account is $800. Up until the point that it closes that trade at whatever amount, let's say minus 200. If it closes minus $200, then only now your new account balance is $800. Your balance will only change when you add more funds to your account, so then obviously it will increase. When you close a position, whether it's in profits or losses, and then when your position is left overnight and you have to pay or receive the swap fee. That's the only time your balance will change. Next one, unrealized profit or loss versus realized profit or loss. First one, unrealized. Now this is, okay, for you to make money in trading, you need to open an account, okay? In some broker platforms, you will see unrealized profit or loss or realized profit or loss. Now, unrealized profit or loss is the profit or loss held in your current open positions. So it is the open positions. It is what's running. Okay, if it's in the minus, it's your drawdown. Equal to the profit or loss that would be realized if all your open positions were closed straight away. Your unrealized profit or loss continuously fluctuates with the current market price up until the point you close it automatically or manually. A realized profit or loss is a completed trade, whether it is in a loss or a profit. Once that trade is fully closed, then it is known as a realized profit or loss. Your profit or losses only become realized when the positions are fully closed. This is the only time when your account balance will change to reflect any gains or losses. So like I said, if you deposited $1,000 and you're currently in a loss or in a drawdown of minus $200 and it's fluctuating, $200, $198, okay, then it's, $230, up until the point it is fully closed. Let's say it's $201 and it hits your stop loss. It automatically closes and it will minus that $201 out of your account. You understand? That is a realized loss. That $201. Used margin, okay? Required margin. Before you know what is used margin, we need to know what is required margin. Depending on the currency pair and broker, the amount of margin required to open a position will vary. When margin is expressed as a certain amount of your account's currency, this amount is known as required margin. Each and every position you open will have its own required margin amount that will need to be locked up. Okay, here's an example of required margin. So let's say you want to place a trade. Euro USD trade. Okay, if you want to buy or sell 100,000 of Euro USD without leverage, you would need $100,000 as your balance. That is without leverage. So you need that whole amount. If you were to use a lot size of 1, if you were to use a lot size of, let's say, 0.10, that is 10,000 units. So you would require $10,000 just to buy or sell that given pair Euro USD. So with a margin of, let's say, 2%, you would only need $2,000 of your own money to open that $100,000 position. Here's an example with 2% margin. So with a lot size of 1, okay, 100,000 units, you would need $2,000. With a lot size of 0.10, 10,000 units, you would need $200. With a lot size of 0.01, you would need $20. Now keep in mind, if you open more than one position at a time, each specific position has its own required margin. If you add up all the required margin of all positions that are open, that total amount is called now, used margin. All of the required margin. Now, used margin is all margin that's locked and cannot be used to open new positions. Required margin is for a certain trade. Used margin is the amount you need to deposit to keep all trades open. Example, you open 2 different trades with $1,000 in your trading account. Number 1, you buy USD Swiss franc with a lot size of 0.10, 10,000 units. And the second trade, you place a buy on USD JPY, also with a 0.10, also 10,000 units. Now, margin required for USD Swiss franc is 3%. For USD JPY, it's 4%. Required margin equals notional value times your margin required. So, number 1, for your USD Swiss franc, it's $10,000 times 0.03, that's the percentage, that's how you calculate percentage, equals $300. USD JPY is the 10,000 times 0.04 because it's 4%, equals $400. So, used margin is the sum of all those required margin. So for USD Swiss franc, your required margin is $300. For USD JPY, your required margin is $400. Now, to calculate the used margin, you just add those two, which is $700. So the two trades equal $700. Okay, equity is the easiest out of them all. It's the most simplest. Equity is basically the current value of your whole trading account. Now, the sum of your account balance and all floating positions, whether it is profit or losses, that is equal to what your equity is. Example, you deposit $1,000. You analyze a pair, Euro USD, and you expect it to rise, so you open a buy position. Now, immediately, price moves the opposite direction, and you're in now a drawdown, floating loss of, let's say, minus $65. So now your equity is your balance, which is what you deposited, $1,000, plus your floating profit or loss, which is minus $65. So your equity is currently $935. Next up is free margin. Margin is classified as either used or free. So we discussed already what is used margin. Okay. Now, free margin is the difference between equity. Also refers to equity in your account that is not tied up in margin for current open positions, and also can be thought of 2 things: amount available to open new positions, amount that existing positions can move against before receiving a margin call. We'll get into margin call. Calculating free margin. So free margin is your equity minus your used margin. If your open position are in profits, your equity will increase. Therefore, you will have more free margin. If your open positions are losses, your equity will decrease. Therefore, you will have less free margin. An example when you have no positions open. So you deposit $1,000. Your equity or balance is 1,000 because remember you had no positions open, no nothing. It's a new account. So your free margin, $1,000 because nothing was open. margin level, right? If no trades are open, your margin level is 0. Brokers use margin levels to determine if you can open additional positions. Example, opening the trade. So, buy position on USD JPY, 0.10 lot size with $1,000. Remember your margin, okay? Notional value times your margin. So, because you're using a 0.10, it's 10,000 units. So, 10,000 units times 4%. Remember, USD JPY is 4%. So, it's 0.04. So, 10,000 times 0.04 equals $400. Use margin. No other trades are open, so it's $400. Equity, price moved back to entry, so 0. Nothing. So now your margin level, okay, is your equity divided by your use margin times 100%. So it's $1,000 because remember your account, there was nothing. You just deposited 1,000. That's it. That's your equity. You had no open positions, nothing. You didn't lose, you didn't win. It's just 1,000 divided by your use margin, which is $400. Okay, times 100%. Gives you 250% margin level. Okay, margin call. Margin call is when the margin level has reached a specific level or threshold. When the threshold is reached, you are in danger of the possibility of having some or all of your positions forcibly closed by your broker. Here's an example at 100%. So margin call, okay, open the Euro USD trade with a 0.10. $200 required margin. Since you only have one position open, use margin is also $200. Trade doesn't go your way, you're down 800 pips. Okay, that's a lot of pips, but anyways. 800 pips equals $800 drawdown because 0.10 equals $1 per pip. Your equity is now $200 because remember, your equity is your balance, plus or minus whatever open trade you had that closed. So 1,000 minus your 800 loss, okay, equals $200. So that's your equity now. Your margin level is now 100%. So how? Equity divided by use margin times 100%. 200 divided by 200, because remember now your balance is 200, your equity, sorry, because of that loss. Divided by your use margin, which was 200. Times 100% equals 100%. Okay. When the margin level reaches 100%, you cannot open any new positions unless A, market reverses back in your favor and into profits, or B, your equity becomes greater than your used margin. Right, if the trade carries on going against you and the margin level falls further, then the broker will be forced to close your trade. This is without hitting your stop loss. You'll just look at your account and then boom, you can't see the trade nowhere. You go into history and you see it's in the minus. This is known as the stop out level and varies by broker. Similar to margin call, okay, it is just much worse. Happens when your margin level falls to a specific percentage, which one or all open positions are closed automatically by your broker. Now it happens because the trading accounts can no longer support the open positions due to lack of margin. When this happens, your broker will automatically close trades, starting with the most unprofitable open trade until the margin level is back above the stop out level. Here is an example with a stop out level of 20%. Stop out level, margin level at 20%, right? We will use the same example as in the margin call level previously. So you have a deposit of $1,000, your use margin 200, your drawdown is minus 800. So your equity is $200. You've already received margin call when the margin level reached 100%, but you decide not to deposit more funds because you think the trade will go back in your favor. You were wrong, and the trade went further against you, and now it's 950 pips instead of 800 pips. Now your equity is $50. Because balance plus floating profit or loss, so 1,000 minus 950 equals $50. So your margin level is now 25%. Equity divided by used margin times 100%. $50 divided by 200 times 100% equals 25%. At this point, your position will automatically close. When your position is closed, the used margin that was locked will now be released.